All right. Let's go ahead and talk about theory first, and then we'll talk about the implication when it comes to the tax preparation of it. Theory, speaking about the law, what are the tax regulations on crypto, and also how are the different crypto activities getting taxed. And then once we've established that point, then we can move on into the reporting of those activities. So what crypto activities do we have? We have trading, right? You buy Bitcoin, you trade it for Ethereum, and then you trade it for Cardano. And all of those implicate a taxable event, right? You know, so it doesn't necessarily mean that you're going to go ahead and get Bitcoin and then sell it for USD again. That records a taxable event, but a taxable event is also trading from one coin to another one.
Really?
Yes.
Well, that's a bitch.
So we're going to go ahead and have like Bitcoin, and then we trade it for Ethereum. You could do that, but that records a taxable event. There are some countries in the world that do not recognize that as a taxable event, but since we're in the United States, it does implicate a taxable event. So therefore, every time that you trade from one coin to another one, we have to record the cost basis of Bitcoin, for example, and record the cost basis to now entering the Ethereum coin that you sold it for, but the cost basis is recorded on Ethereum now, right? So we have to kind of keep track of the proceed of Bitcoin when you exited the position, and now you're entering a new position of Ethereum, so that's a new cost basis that we have to keep track of. And as you guys can imagine, people that are trading, you know, so many different coins, it's going to be impossible to come up with a cost basis or the calculation of the cost basis specifically to the fair market value of the coin, since the markets are so volatile. So it becomes incredibly difficult to track the cost basis, the timestamps on when I entered this position, when I exited the position, whether I'm using LIFO, FIFO, or, you know, as far as like the coins, because, you know, I'm not selling the full position of my Bitcoin position, I'm just selling a small portion. So am I considering, if I'm dollar cost averaging, am I considering the cost basis from the initial purchase of Bitcoin that I had when my cost basis was 3,000, or am I considering the cost basis when I purchased it at 50,000, right? So we have to first consider that there is a lot of complications to when it comes to only expecting a report from our clients or expecting that we can just average the purchasing price to then us calculate the cost basis of this. Because what happens is that in crypto, the exchanges do not provide us with a 1099B. Nothing. They don't provide with anything. We have to come up with our own cost basis. So how are we going to deal with that? Well, the way to deal with it is with software. So we have a software, CryptoTrader.tax or Coinly.io, which I'll explain to you guys what that is. But basically, we have all these different wallets on DeFi or centralized exchanges like Coinbase or Binance or whatever the client is buying the crypto. And what we're seeing is that after, for example, someone entering the crypto market deposits their money in Coinbase. Then once they have Bitcoin or Ethereum, then they start getting to know what the DeFi world is, you know. So now they want to go ahead and invest in DeFi like Olympus DAO or Hex or whatever. So they're going to then send that Ethereum into their MetaMask, and then you're completely decentralized now. The MetaMask is not going to give you a report. It's a decentralized exchange, you know. So there's no one behind it that says like, oh, this is a report for the deposits or anything like that.
Or the fees you have to pay.
Or the gas fees, exactly, or the gas fees that you have to pay. So then how do we track all this? You know, it's almost impossible if we don't have the appropriate tools. So therefore, CryptoTrader.tax allows you to connect all the exchanges that are centralized, like Coinbase and Binance, and also all the DeFi wallets that you may have. You know, so you're going to be able to connect your MetaMask wallet as far as just seeing the transactions, because in the crypto world, you can look up all your transactions in the blockchain. So if I look up your wallet address, I'm going to go ahead and see what got transferred in and what got transferred out, or what you were able to purchase. And it's going to record the fair market value at that time of purchase, because it has a timestamp, time, date, and everything. So what the software does is to basically get all this blockchain information into the software and traces it from the moment that you did an fiat on-ramp, meaning that you bought with cash crypto, all the way to wherever you sent it in DeFi. If it's attached to your wallet address, you're going to be able to trace back all those different transactions and be able to calculate the cost basis, and the software is going to do it for you. So once the software basically says, okay, we have all these different wallets, all these different exchanges that got synchronized into it, I'm still missing a few things. There is a bonus amount of $5,000 in here that is not being tracked. Where is this from? And that's where we take some work into. That's where we put in some work. We cannot expect the software to do everything so perfectly because there's other activities, like for example with Olympus DAO, that is going to go ahead and give us interest. So, let's go ahead and go into the topic of what are some of the activities that exist in crypto. Well, there's a regular trading, like I explained. You buy something at a price with expectation of profit. So therefore, you hope to have an appreciation in price, and therefore you're going to go ahead and deal with capital gain. That's it. Simple. Another activity that we have is yield farming. Another activity that we have is staking. Yield farming. Yeah. It's just a short term for let's go ahead and get interest or fees from making our capital work. So yield farming could be providing liquidity to an exchange or to a liquidity pool so we can earn transaction fees from people trading in a DeFi exchange, right? So it's a little more complex. We don't need to get into what that is, but all you got to learn is that there's fees that you earn in the local crypto. So therefore, you're basically, how are you going to track the cost basis of that extra crypto that you just received? An airdrop is basically you participating in something and they're giving you a reward of a certain coin as a gift, for example. That's called an airdrop. Or you're putting your money in there to earn interest. So you're making your capital work for you and therefore you're earning interest. All those activities are going to get recorded on CryptoTrader.tax, but they're not going to have a cost basis. Well, they will have a cost basis, but because he records it at the fair market value, but he's not going to know whether you purchased it or you got it as an airdrop. So it's our job to then see like, okay, where did these portion of coins of Ethereum or Hex or Olympus DAO came from?
Was it earnings or purchase?
Exactly. So then we have to categorize those transactions as income. So the two activities that we have, which is earning interest and capital gain, we're going to treat it as such. If the client is earning income, then we're going to go ahead and record it as income. In CryptoTrader.tax, we're going to go ahead and classify those transactions as income. So therefore, when we go ahead and pull out the report, we're going to then we can synchronize it to the tax software to make it easier too. But it's going to recognize a certain portion of it as income and then another certain portion of it as either a capital loss or a capital gain.
When you say income, do you mean like other income or?
Other income or interest.
Wait. So it's considered interest, but you calculate it as interest based on the value of the coin that they got it at?
Yeah, let's talk about the law on why is it that like, so for example, let's say, Walter, you do something, right? Like you're doing a job and I pay you in corn.
Okay.
How are you going to record that in your taxes?
Bartering?
Using the.
Well, it's not. Well, sure.
Wouldn't you go based off the market value at the time when you got the coin?
That's exactly right. Fair market value for the object. So we're talking about a commodity, or we're talking about it's not.
Tangible asset.
That's correct. So, as we know, crypto is not considered a security, so therefore we consider it, something really in relationship to a commodity. So the fair market value is important to have at the moment of receipt. So when you're earning the interest, let's say that you earn interest every single day, well, the fair market value of that interest is going to be then different every single day, and it's going to have a different value at the end of the year as far as what we have to record. There are other complications that go into it as far as like what constitutes a fair market value or when are you receiving that interest. Like with Hex, you don't receive the interest until the maturity of the stake, like a CD. And therefore, since you mint the coins into existence, it doesn't get recorded as a fair market value up until the date that you're expiring that stake. Instead of recording the fair market value of everyday interest that you're earning, it's up until the point that you mint all the different coins. Anyway, the software is gonna do all of that for you.
My question is this
I was
though.
like, that sounds like a lot
We
of
have to
work.
pay taxes on,
The interest and the capital gains.
but that's also relevant to the market, right?
Well, explain.
Bitcoin, I bought it at 50,000, and boom, it made me 66,000 by the end of the year. But then in January, it went down to 40.
Mm-hmm.
So I didn't pull it out.
Okay.
I just kept it there. So in 2020, 2021, where I'm going to be paying capital gains of $10,000, and in 2022, like, you get what I'm saying, like.
Yeah, but you didn't sell it though.
No,
Until you sell it.
he's talking about two different things. He's talking about the interest you earn
Like
on
on
staking.
Yeah, I know that one.
Yeah, and then he's talking about the capital gains.
When you pull out.
Yeah, when you pull it out.
But he also says, like, you pulled it out to buy another coin. You never pulled it out to your bank account. You just
Oh yeah.
swapped it.
If you swapped
you bought
it,
another
that's
coin.
yeah.
At that moment that you swapped it, if it had a value higher than when you purchased it, that's
It's gonna
what
be a
you're paying
gain.
for.
Yeah, yeah, that's definitely a gain. So that's where.
What?
But
That's how
yeah,
they treat
that's
it?
insane. That's what I'm sort of
Wouldn't it just be
upsetting
like
too.
a?
So let's just say I bought from
I know.
crypto. I swapped it right for a Link, and Link I bought it at this price, but crypto I had a gain of $10,000, and in Link in that same year I lost.
It's gonna offset if you sold the losing position.
Right.
You know, so
What
so
if you didn't?
then you only record the capital gain.
That's what sucks because
Yeah.
in the long run, what if 2-3 years from now
But that's
you lost the money?
but this is your job
it's
right
like
here.
forcing you to pull out every time
Well,
you gain
this
something.
that's what he's trying to bring it out. Like, this is the law, and this is.
No.
What-
This is your job right now as a tax strategist, as a tax person, to be able to know what's going to go ahead and offset your capital gains. And as a trader or as a crypto investor, you have to recognize that there's no wash sale as we have in the security world. Do you guys know what wash sale is? Okay, so when you
What's
buy
that again?
wash sale.
Oh, wash sale.
Yeah, so in the securities world, we have a stock. Let's say that we bought Tesla at $400 and then it went down to $300. Let's say that we sell the position at a loss of $100. And you know, you cannot reconsider your position. You're like, no, you know what? I'm really for Tesla for the very long term. So I'm going to go ahead and rebuy my position. And then boom, a month later it goes to like $500, right? And then you're like, all right, I'm going to capture my gains on that. But you know, and in your mind, you're like, okay, well, it's not supposed to be a $200 capital gain because I went ahead and sold it at $300. So I'm going to go ahead and record that $100 loss against a $200 capital gain that I had. Well, too bad. Securities have wash sale, and if you rebut your position within a 30-day period, the losses are disallowed. So you only record the $200 capital gain. That's the
you
wash
have
sale.
to purchase it within 30-day period.
If you repurchased it within 30 days,
It
then
doesn't
wash
count.
sale applies.
Then a wash applies.
Then if you rebut your position after 30 days, then wash sale does not apply, and therefore you can record your position, the loss.
But that's just stocks.
That's just stocks.
Aren't
So
they gonna add that to crypto too?
yeah, well, it's not applied yet.
Okay.
So until the end of the year, I'm still selling all my losing positions and rebuying my positions because they're long term.
Got it.
So this is what we call tax loss harvesting. We harvest those losses. So back in May, for example, when we had that big dip, my portfolio was gone like 80%. I sold all my positions and rebought all my positions knowing that crypto was going to go back up. But I sold all my positions just to record those losses. So when my crypto went back up and I sold it at a certain point, they would offset the capital gains that I would record. Because wash sale does not apply to crypto because it's not a security. Wash sale only applies to securities. At a certain point, if, for example, what they were trying to propose in the infrastructure bill, where certain coins in the United States or projects that are based in the United States would be considered brokers, then that would be a different story because then they would be securities and therefore, and what they're trying to do with stable coins is to make them securities. So we would go into wash sale applying into the cryptos that are now being considered securities, right? In this moment, it's all speculation. It hasn't gone through. The infrastructure bill is still kind of like negotiating back and forth, all these different things. So nothing is concrete yet. But yes, at a certain point in time, wash sale, some sort of wash sale rule will then apply to the crypto, but it hasn't been proposed yet as far as what is it that they're going to go ahead and do with that. So we'll know. We'll know. But in the meantime, as your job as a tax preparer, you should definitely tell your clients. And look, you guys have to kind of break down the misconception or the mindset that crypto investors have, which is huddling. Huddle. Don't sell your stuff because then you have paper hands. You have to have diamond hands and fucking hold your position for a very long time, like years to come.
This big dip would have been good to sell your position
And
and then rebuy it and take
30
that
days.
loss.
Yeah. Instead
No,
of
the 30-day thing doesn't apply because of the watch sale.
Oh, okay. So
None
that
of
worked out.
So-
those apply to me because I've always bought.
But you.
I have no losses, even if it
Yeah,
drops.
technically.
no.
No, if I bought everything at $5 and it went to 40,
No, but
and
you
it
bought
dropped
more
to
things
20,
recently this
and
year.
it dropped to
You
20,
bought more things
like I
recently.
still
Like
bought it at
Olympus.
5.
Like Olympus is one of them. See what
Yeah.
I'm saying? You have other things that you can sell and take the hit because that then rebuy at that low price again, and then offset it with the loss.
So then I should sell some of the. Oh wait, no,
Well,
that's
whatever your position is. If you
Oh,
have a
return is
position that you
interest.
bought it high and it went low,
That's all interest. That's income for you.
So if I sell it, whatever I staked,
It's income.
at a lower price than when I actually purchased it.
You didn't purchase that. You literally got it as interest.
no, the interest
Okay,
thing is
but-
separate from the
Okay, so
one
then
you,
it's just the stocks and the crypto. Then if I purchase
the value
something,
of the coin when you bought it.
I need to get those.
You still pay. Look,
those apps. 'cause
I understand what you're
my-
saying,
My
so-
stuff is a mess.
So well, we are working on that. The interest.
like Link, I bought it at a stupid price, and then it's all at really low. I should sell it,
Yes.
and then
Yes.
Rebuy it again.
Yes.
yeah, if you believe in the project very long term and you would like to regain what you lost because then you know that it's probably gonna go back up, then you should definitely eliminate those positions and rebuy
Yeah,
it
that's
like
pretty
immediately
cool.
within 5
I know
minutes.
that.
You know, like sell your position, boom, you record the loss, rebuy your position. You still hold the same amount of position. You probably spend like $30 in gas, but whatever, you record the capital loss in there to offset any other capital gain that you're gonna go ahead and have.
so sell it and then buy it again.
Exactly.
Yeah.
So then you're gonna go ahead and record that loss. But now let me get back into taxes real quick, right? So when we're dealing with all of this, then we're gonna recognize that the interest received or the airdrops, they're gonna be considered income at the fair market value when we received it, right? Now you still pay capital gain if it has a certain appreciation in price, right? Let's say that you are staking Cardano in your Yoroi wallet and you're earning interest of 5%. Once you're earning all these 5%, you're earning it at the fair market value of, let's just say, $1.50.
Of what Cardano's worth.
Yeah, whatever fair market value at the current moment, right, that you're receiving your interest. Now, what happens now that you've accumulated all this Cardano? Well, in the current year, you're going to go ahead and pay ordinary income tax because that's considered income, interest earned. So what happens that at a certain point, then Cardano, then when you received it, it was $1.50, you hold it, and then it hits $5. You're like, nice, I built all this interest, I already paid taxes on my income, now I'm going to sell it for an appreciated price. Well, you're still going to go ahead and pay capital gain because your fair market value or your cost basis was at a certain point $1.50. You're selling it at $5, so therefore you still have a capital gain.
Plus interest.
Yes, exactly. So you're going to pay two taxes on the same coin. One's when you received it as income, and the other one is when you are selling. Then therefore, if it has an appreciation, would be capital gain. If it has a loss, then it would be capital loss. In your case, as an investor, you would still be at a profit because you got that for free, right? So those are the two case scenarios that you guys are going to have when it comes to receiving all these reports from clients. What we need to have is ask them specifically about what sort of activities do they have. And you guys need to be familiar with the terms. Do you do any yield farming? Do you do any staking on your coins? Did you buy and sell any coins either in a centralized exchange like Coinbase or decentralized exchange like MetaMask or SushiSwap or...
So yield
One
farming,
whatever those things are.
yield farming, staking, what else? And then also, did you buy what?
Did you buy and sell?
Uh-huh.
Did you buy and sell in a centralized or decentralized exchange, like SushiSwap, or Uniswap, PancakeSwap?
Binance.
Binance is centralized, yeah.
Decentralized.
Yeah, but I'm saying decentralized platform.
No,
Yeah.
it's decentralized.
Centralized or
Buy and sell-
decentralized?
Did you buy and sell in a centralized or decentralized platform?
Mm-hmm. You got it.
Did you stake? As
Yeah,
far as did
stake
you receive
and
any
do you
income?
from-
Airdrops.
Yeah, did you participate in any airdrops? People that they suddenly get free airdrops and they get like free coins and then they sell out, or they go ahead and some people are smart. They receive an airdrop, they see how it's dumping, and they only sell at dumping price to record a capital loss and only income in that position. So they're able to offset it, and then they rebuy the position knowing that they're
So that's why
gonna
some
go back
people
up.
sell and buy quick, huh? Because they see the loss and then they buy in again.
Well, the smart people do it.
That's what I'm saying. Like
Yeah. Like
You just called me dumb.
no, because you're a game. You don't have losing positions. But what you should know is that, like, whenever you are at a loss, you should break the mindset down from people saying that I should be hodling for years. You should be like, yeah, you should be holding your position for a long period of time, but if there's a dip and you're at a loss,
Take advantage.
sell it and rebuy your position so you can record the capital loss and can harvest those losses throughout the whole year. That's a little strategy that you guys can use for your clients.
But it sucks that you're paying gains 1 year. Let's say you never sold anything. You'd be paying gains 1 year, and you could be paying losses the next year. I mean, you could be reporting losses the next year
Yeah.
if you just hodl it, which would be so unfair.
But why are you selling?
I mean, the best way that the government should have done is once it turns into fiat, like
Sure.
USD is when that's
But
probably
that
would have been a lot
does
easier.
but that's not the way it works out. So
They're just trying
it's like I give you corn and then you give and then I with that corn I'm buying
I
a
go
car.
sell it as soon as it turns into cash, and then I pay the taxes on the cash.
Well,
I sold
it doesn't even matter because if you pay me with corn, I'm gonna pay taxes on the income that I received at the fair market value of this corn. And then let's say I want to buy a computer with my corn, that's still a taxable event.
Mm-hmm.
You see, it doesn't really matter. It's the same thing with Bitcoin and Ethereum and all that kind of stuff. I don't think it's unfair. I think that it constitutes at a taxable event because if you bought Bitcoin at 10,000, you're selling it at 50,000 to buy Ethereum. You're still capturing the gains of Bitcoin.
It's unfair because it's federal taxes, and the reason we're trying to charge is because we're using their federal fiat. Taxes is because we're using the federal bank reserve, right? So if we didn't use their cash, their money, and we bartered, they shouldn't be charging us taxes because we're not using their fiat.
I don't think that's why they charge
That's really
taxes,
what
but
well, it's called federal taxes for a reason.
no,
because
but
they're
the
Reserve.
Federal Reserve is not even a governmental institution.
But they're charging taxes on the fact that we use their fiat. So I'm telling you.
Look, I have a thing with taxes, and that's why I'm in this field. We shouldn't pay taxes because if they're printing all these money supply, they should be able to take care of their own shit.
And
Where
I
the
feel
money
like we
supply
shouldn't
that
pay
they're
taxes
printing.
if we don't use their fiat, right? Because that's what they.
But this is where we go in. It doesn't really matter what constitutes or what doesn't constitute. We go by what the law says specifically in this moment, and then we as tax planners, then we go into how are we then going to not pay any taxes. So then we go into the two different categories that we have. We have capital gain taxes, and then we have income. What are the two things that we're going to be using for us not to pay any taxes on that?
The loss is.
The law says that we can offset capital gains by taxless harvesting in commodities, so therefore we're going to use that for capital gains. How are we going to offset all the staking activity that you have if you're considering, like for example, Olympus DAO is giving me like $15,000 a month, $9,000 a month, $7,000 a month. How am I going to go ahead and constitute that? Well, I have a corporate wallet address where I have my Olympus DAO coming in, and therefore I'm reporting all of that money inside of there, so therefore I could offset it with all the gas fees and traveling expenses that I have and meetings that I have with people, like all these different things, so therefore I could offset that income, with regular office expenses that I have.
So you open up a corporation, and that corporate account, you link it to your DAO, or you can actually link it to all your platforms?
You can link, you need to open up a wallet address that's specifically KYZ, or not KYZ, but specifically that you use it for corporate purposes.
Can you do that with MetaMask?
Not a corporate account, but you could like the MetaMask account will never be used. Like it's only going to be linked from the on fiat exchange that is KYZ has already
For the
KYZ your
business,
corporate
yeah.
account.
I see.
So it doesn't link, right? But the transaction has been sent to this MetaMask, and there's no other transactions from any other wallets that are going into. So you just got to keep it very, very clean.
Got it. Just keep like don't use anything that's.
So we gotta KYC immediately, huh?
Well, no, we just gotta make sure that it's for the business.
Which brings me to the next point. Corporate clients that are adding Bitcoin or any other cryptocurrency into their balance sheet. A lot of our clients are buying cryptocurrency with corporate assets. So therefore, we need to do something about it. Okay, so individual accounts are different than corporate accounts, and they have to be tracked in a different manner. If I'm buying and selling Bitcoin, Ethereum, and whatever, even in the centralized exchange or decentralized exchange, I can just use the tools like CryptoTrader.tax and Coinly to be able to track the cost basis, the proceeds, and all that kind of stuff, and it's gonna go ahead and make my work a lot easier. But what happens when our corporate clients are buying Bitcoin with their corporate funds? Shit. Now they're buying an asset that we have to control. How are we going to record that in the balance sheet? Where we're going to put it as an asset. Obviously, in the accounting wise, against cash, we add it as other asset. We're going to have to open up a category specifically for cryptocurrency. And then we're going to go ahead and have to have a specific worksheet attached to the balance sheet that says, this is a cost basis, this is a timestamp when they got it. We have to elect the method, LIFO, FIFO, whatever it is that they have, because if they start selling some of those profits to bring back into the operation, then we have to record the capital gain on those.